What if the system you trusted with your money was built on a lie so massive it could only survive in the shadows? Picture this. A scheme so audacious it fooled the sharpest minds in finance, regulators, and even the public for decades. Not just years, but generations. A deception woven into the fabric of Wall Street itself, growing bigger, bolder, until one day it unraveled in an instant. This is the story of how the greatest fraud in financial history stayed hidden for so long and why its collapse shook the world. This isn't just about money, it's about trust, betrayal, and the fragile illusions that hold our economic systems together. We're diving into a tale that spans decades, blending ambition, secrecy, and the raw power of belief in a system that seemed too big to fail. Let's step back in time to uncover how it all began. The story starts in the early days of modern Wall Street, when the world was still reeling from the Great Depression. The 1930s were a time of shattered dreams. Banks had collapsed, fortunes evaporated, and trust in financial institutions was at an all-time low. Into this void stepped a man named Charles Ponzi, though his name would later become synonymous with fraud. But Ponzi's scheme, audacious as it was small compared to what would come later. His idea was simple. Promise investors impossible returns. Pay early investors with money from new ones, and keep the cycle going. It worked until it didn't. By 1920, Ponzi's empire crumbled, but his legacy planted a seed. Fast forward to the 1980s, when Wall Street was a different beast. The markets were booming, deregulation was the mantra, and greed was good. Amid this frenzy, a new kind of fraud took root, one far more sophisticated than Ponzi's crude hustle. This was the era of Bernie Madoff, a respected financier, former Nasdaq chairman, and a man who seemed to embody the American dream. Madoff's investment firm promised steady, almost magical returns year after year, no matter the market's ups and downs. Clients flocked to him, hedge funds, charities, Hollywood stars, even European royalty. His secret? A black box strategy he claimed was too complex for most to understand. The truth was far darker. Madoff's operation wasn't investing in stocks or bonds. It was a Ponzi scheme on an unprecedented scale, using new investors' money to pay off old ones, creating the illusion of wealth. For decades, he operated in plain sight, shielded by his reputation and the trust of those around him. Regulators missed red flags. Auditors signed off on fake reports. The system, designed to catch fraud, seemed blind to it. Why? Because Madoff wasn't just a man. He was a symbol of success in a world that worshipped it. To understand how Madoff's fraud grew unchecked, we need to look at the history of trust in financial systems. After the 1929 crash, the U.S. government created the Securities and Exchange Commission, SEC, to protect investors. New rules, like the Glass-Steagall Act, separated commercial banking from risky investments. These measures rebuilt confidence, but they also created a blind spot. People assumed the system was safe, that regulators were watching. That trust became a vulnerability. Take the case of the 1960s salad oil scandal. A commodities trader named Anthony DeAngelis fooled banks and investors by claiming to store millions of gallons of salad oil in tanks. The catch? The tanks were mostly filled with water, with just a thin layer of oil on top. Inspectors, trusting DeAngelis's paperwork, never checked closely enough. The scam collapsed, costing investors millions and exposing how easily trust could be exploited. This wasn't just a one-off. It was a warning of what happens when faith in a system overrides skepticism. By the time Madoff's scheme took shape, Wall Street had changed again. The 1980s and 1990s saw a wave of financial innovation, complex derivatives, hedge funds, and high-frequency trading. These tools promised wealth, but also created opacity. Madoff thrived in this environment, using jargon and prestige to deflect questions. His investors, from sophisticated institutions to everyday retirees, didn't ask too much. The returns were too good, the story too compelling. History shows us this pattern. When trust is high and scrutiny is low, fraud festers. Madoff's scheme wasn't confined to New York. It spread across continents, pulling in billions from investors worldwide. In Europe, banks marketed Madoff's funds as safe bets. In the US, feeder funds funneled money to him, skimming profits without questioning his methods. The scale was staggering. At its peak, Madoff's firm claimed to manage $65 billion in assets. None of it was real. Every statement, every report was fiction, meticulously crafted to keep the illusion alive. Consider the story of Elie Wiesel, the Nobel laureate and Holocaust survivor. His foundation entrusted its endowment to Madoff, believing in his reputation. When the truth came out, Wiesel's charity lost everything. This wasn't just financial devastation. It was a betrayal of trust on a deeply personal level. Stories like these multiplied as the scheme grew, touching lives far beyond Wall Street's towers. Yet there were warnings. As early as 1999, a financial analyst named Harry Markopolos flagged Madoff's returns as statistically impossible. He sent detailed reports to the SEC, spelling out the fraud. Nothing happened. The SEC, underfunded and overwhelmed, dismissed him. Madoff's prestige and connections shielded him. The system wasn't just failing, it was complicit in its own blindness. By the early 2000s, Bernie Madoff's Ponzi scheme was a juggernaut, fueled by a steady stream of new investors and an unshakable aura of success. But beneath the surface, the foundation was rotting. The global financial system was about to face its own reckoning, and Madoff's house of cards would not be spared. The 2008 financial crisis, sparked by the collapse of subprime mortgages, sent shockwaves through Wall Street. Markets plummeted, banks teetered, and investors scrambled to pull their money out of anything that looked risky. For Madoff, this was a death knell. Unlike legitimate funds, Madoff's operation had no real assets to liquidate. Every withdrawal request was a threat, forcing him to scramble for new cash to cover payouts. As the crisis deepened, the demands grew louder. Longtime clients, from wealthy individuals to massive institutions, wanted their money back. Madoff's charm and excuses could only hold them off for so long. By late 2008, the inflow of new money slowed to a trickle and the scheme began to implode. Picture a man at the center of a web, each thread a promise to an investor. For decades, Madoff had spun this web with precision, but now it was unraveling. In December 2008, he confessed to his sons, Mark and Andrew, that his empire was all just one big lie. The admission came not out of guilt, but necessity. He could no longer keep up the facade. His sons, stunned, turned him into the authorities. Within days, Madoff was arrested, and the world learned the truth. The greatest fraud in Wall Street history had collapsed overnight. The revelation of Madoff's fraud was like a bomb detonating in slow motion. Investors, from retirees to charities, discovered their life savings were gone. The $65 billion in reported assets was a mirage. The actual cash in Madoff's accounts was a fraction of that. Families lost homes. Foundations shut down. Some victims, overwhelmed by shame and loss, took their own lives. The ripple effects reached far beyond the US. In Europe, banks that had funneled billions into Madoff's funds faced lawsuits and ruin. The human toll was staggering, a reminder that behind every dollar was a dream, a plan, a future erased. Take the story of a small charity in Massachusetts dedicated to funding cancer research. It had entrusted its entire endowment to Madoff, lured by his consistent returns. When the truth emerged, the charity folded, leaving researchers without funding and patients without hope. Or consider the elderly couple in Florida who had invested their retirement savings with Madoff through a feeder fund. They were forced to sell their home and move in with their children, their golden years reduced to dependence. These stories weren't just headlines, they were lives upended. The financial world reeled too. Madoff's fraud exposed gaping holes in the regulatory system. The SEC, already under fire for missing the 2008 crisis, faced intense scrutiny. How had they ignored Harry Markopolos' warnings for nearly a decade? Why had no one questioned Madoff's impossible returns? The answers lay in a mix of incompetence, underfunding, and a culture that revered success too much to question it. Madoff had exploited this, using his status as a Wall Street titan to deflect suspicion. His arrest forced a reckoning, but for many it came too late. Madoff's collapse wasn't an isolated event, it was part of a larger pattern in financial history. Look back to the 1920s, when the Mississippi Company in France promised riches from colonial ventures in the New World. The company's stock soared, fueled by hype and speculation, only to crash when the promised wealth never materialized. Or consider the 1990s dot-com bubble, where companies with no profits commanded billion-dollar valuations based on nothing but optimism. Each time, the allure of easy money blinded investors to reality. Madoff's genius, if you can call it that, was in blending into this history while scaling his deception to new heights. He didn't promise outrageous returns like some fly-by-night schemers. His were steady, believable, almost conservative. He understood that trust was his greatest asset. By positioning himself as a pillar of the financial community, he turned skepticism into a sin. His downfall echoed these earlier crashes, but on a scale that dwarfed them. A stark reminder that the bigger the lie, the harder it falls. In the years that followed, Madoff's name became a byword for betrayal. He was sentenced to 150 years in prison, a symbolic punishment for a crime that could never be fully undone. Efforts to recover funds dragged on, with liquidators clawing back money from early investors who had profited unknowingly. But the losses were too vast, the damage too deep. The real question wasn't just about Madoff, it was about the system that let him thrive. Wall Street itself faced a moment of introspection. Regulators promised reforms, but skepticism lingered. Could the system ever truly protect against someone as cunning as Madoff? His fraud exposed a truth that cut deeper than the money lost. Trust, once broken, is hard to rebuild. From the ashes of his scheme, new regulations emerged, but so did a lingering unease. If it happened once, could it happen again? The story of Bernie Madoff is more than a tale of greed. It's a mirror held up to the systems we build and the trust we place in them. For decades, his fraud grew in the shadows of Wall Street's ambition, protected by a world that wanted to believe in the impossible. When it collapsed, it left behind not just financial ruin, but a question that lingers still. What else might we be blind to? The greatest fraud in history wasn't just Madoff's doing, it was enabled by a system that forgot to question its own foundations.